Question 246. In India, a large part of debt securities pay interest on A. A floating rate basis. B. A fixed rate plus a variable portion. C. A fixed rate. D. Zero coupon basis. Answer C. A fixed rate. Question 247. The Indian debt market is largely wholesale in nature. A. True. B. False. Answer A. True. Question 248. In the wholesale debt market, the largest proportion of trading is seen in A. Government securities. B. Corporate bonds. C. T-bills. D. PSU bonds. Answer A. Government securities. Question 249. The largest proportion of trades done in the wholesale debt market is accounted by A. Mutual funds. B. Foreign banks. C. Indian banks. D. Financial institutions. Answer C. Indian banks. Question 250. Certificates of deposits, CDs, are issued by A. Regional rural banks. B. Corporates. C. Scheduled commercial banks. D. None of the above. Answer C. Scheduled commercial banks. Question 251. Commercial paper is issued by corporate bodies. A. To meet short-term working capital requirements. B. To finance the acquisition of long-term capital assets. C. To retire long-term debt. D. To pay dividend. Answer A. To meet short-term working capital requirements. Question 252. Government securities are issued through the RBI. A. True. B. False. Answer A. True. Question 253. The yield on Treasury bill, T-bill, is determined by A. The Government of India. B. Auction. C. The state governments. D. Floating rate method. Answer B. Auction. Question 254. Which of the following are not normally found in the portfolio of a debt fund? A. Long-dated government securities. B. Corporate debentures. C. Bonds issued by financial institutions. D. Certificates of deposit issued by banks. Answer D. Certificates of deposit issued by banks. Question 255. Which of the following do not represent the amount an investor of a debt security will be paid upon maturity? A. Par value. B. Face value. C. Fair value. D. Redemption value. Answer C. Fair value. Question 256. Coupon of a debt security refers to A. A piece of paper attached to the certificate. B. The return on investor would earn. C. The amount rate of interest paid on par value of the bond. D. None of the above. Answer C. The amount rate of interest paid on par value of the bond. Question 257. Which of the following do not apply to the term maturity of a debt security? A. The date on which the certificates becomes old. B. The term of the bond. C. The date of redemption. D. The date on which the issuer has to repay the amount. Answer A. The date on which the certificates becomes old. Question 258. Call or put provisions are used to modify the fixed maturity of debt securities. A. True. B. False. Answer A. True. Question 259. A call provision in debt issue allows the issuer to A. Call out the names of the investors. B. Redeem the debt on maturity. C. Extend the tenure of the debt. D. Redeem the debt before maturity. Answer D. Redeem the debt before maturity. Question 260. A put provision in a debt issue allows A. Investor to put away the certificates in safe deposit vaults. B. Investors to redeem debt prior to maturity. C. Issuers to redeem debt prior to maturity. D. Investors to extend the tenure of debt. Answer B. Investors to redeem debt prior to maturity. Question 261. Current yield relates interest on a security to A. Its current market price. B. Its face value. C. Its fair value. D. The current price of T-bills. Answer A. Its current market price. Question 262. To compare bonds with different coupon rates, maturities and prices, investors would use A. Current yield. B. Technical analysis. C. Yield to maturity. D. Fundamental analysis. Answer C. Yield to maturity. Question 263. When interest rates rise, bond prices A. Also rise. B. Fall. C. Are not affected. D. Fluctuate either up or down. Answer B. Fall. Question 264. Yield curve is also known as A. Curve of interest. B. Term structure of interest rates. C. Curve that yields. D. None of the above. Answer B. Term structure of interest rates. Question 265. An important indicator of expected trends in interest rates is A. The economic times. B. The Sensex. C. The yield curve. D. The Chief Minister's speech. Answer C. The yield curve. Question 266. It may not be possible to reinvest interest received at the same rate as principal. This is known as A. Reinvestment risk. B. Inflation risk. C. Interest rate risk. D. Call risk. Answer A. Reinvestment risk. Question 267. A bond's rating indicates its A. Reinvestment risk. B. Default risk. C. Inflation risk. D. Interest rate risk. Answer B. Default risk. Question 268. If a bond cannot be sold at a price near its value, it means that investment in this bond has A. High liquidity risk. B. High default risk. C. Low liquidity risk. D. Inflation risk. Answer A. High liquidity risk. Question 269. The additional yield required to account for the risk of default by the borrower is known as A. Yield plus. B. Yield spread. C. Yield extra. D. Yield premium. Answer B. Yield spread. Question 270. A high credit rating does not mean A. High yield spread. B. High perceived safety. C. Low yield spread. D. Low risk premium. Answer A. High yield spread. Question 271. If 10-year government securities yields 10% and a 10-year fixed deposit in a company yields 12%, the yield spread is A. 12%. B. 22%. C. 10%. D. 2%. Answer D. 2%. Question 272. The duration of an interest-bearing bond is A. Longer than its maturity. B. Less than its maturity. C. Equal to its maturity. D. The quality of paper used for the certificate. Answer B. Less than its maturity. Question 273. A bond with a coupon of 9% when interest rates for similar maturities are 11% will sell A. Above par. B. Below par. C. At par. D. At a price unrelated to the prevailing interest rate. Answer B. Less than its maturity. Question 274. Changes in foreign exchange rates have no bearing on interest rates. A. True. B. False. Answer B. Less than its maturity. Question 275. Inflation and interest rates are inversely proportional. A. True. B. False. Answer B. False.